Welcome to Idea to IPO. My name is Rob. I organize Idea to IPO. We've been doing events in Silicon Valley for many, many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 100,000 members among all our meetup groups all around the world. We've organized, promoted, and produced over 2,345 events. By any standard, by any measure, we're the most active, most prolific startup event organization in the history of Silicon Valley, bar none. We organize venture capital panels, legal workshops, networking events, and more. These days, we're 100% online. We have an event on our calendar nearly every day of the week. Check out our schedule at ideatoipo.com. Our featured speaker today is one of the top startup and venture capital attorneys in Silicon Valley, and he is passionate about helping entrepreneurs succeed. Ladies and gentlemen, Roger Royce. Roger, take it away.
Okay, thanks, Rob. Thank you, Idea to IPO, for hosting and sponsoring this event. I'm going to be your presenter here. So if you can't see me, send me a chat, because I don't see me on screen here. Give me a second here. All right, nobody's chatting me, so I guess it's working. Okay, so for today, we're going to talk about funding 101 for startups, for tech startups primarily. Looking good, great, thanks. Tech startups, funding 101. And we'll go in traditional IPO fashion. I'm going to speak for an hour. I've got 82 slides. I won't get through half of them, no doubt. But if you'd like to see all the slides, just email me or text me or send me a message, and I'll send you the slides after the presentation. We'll go for 1 hour, and then we'll do Q&A from 8 o'clock until 8:30 Pacific time. So if you have a question, type it in the Q&A box down at the bottom of your screen. We've already got a question here. The question is, thank you for doing this. Good question. Type your questions there. Don't use the chat box to type questions. It's too distracting. And then we'll go until 8:30 with Q&A. Now, before we get started, I am going to go ahead and launch a poll. I'd like to know who is in the audience. So I have launched a poll. Let me know, are you an entrepreneur? Are you an investor? Are you a service provider? Are you in education? Are you in government? Wow, a lot of entrepreneurs, mostly entrepreneurs, quite a few service providers today. That's interesting. Quite a few people identify as technologists. Nobody from government, good. The IRS is not stalking me here. So far, 65%, 66%, almost 2/3 are entrepreneurs. We have a few investors, we have a handful of service providers, and 15% technologists. All right, thank you for that. So I'm going to close the poll. I'll leave it open just a couple more seconds. And while I leave it open, I just want to let you know we are recording this. This presentation will be available on the Idea to IPO YouTube site. It will also be available on my personal YouTube site. Just go look for Roger Royce or Royce Law on YouTube if you want to see a recording. If you want the slides, email me. And also, if you'd like a copy of my book, Dead on Arrival, how to avoid, what's the name of my book again? Yeah, How to Avoid Legal Mistakes That Could Kill Your Startup. Send me a message. I will send you a digital copy of this book. It's a little dated, but still it's timeless. Good advice on how to avoid legal mistakes. We're not talking just about law tonight because you kind of take your speakers as you find them. I'm going to talk a lot about law, but not just about law. I'm going to talk about how to find funding. Now, I'm a lawyer. I work with Haynes & Boone. I'm a partner with Haynes & Boone Palo Alto office. I work with technology startups and with the venture capital. Both the funds and the companies themselves. And what I'm going to talk to you about is how a startup company can get money even in these COVID times, where you might be able to find funding. part of this is legal, but most of this is going to be good practical advice from the thousands of companies that I've seen in the 35 years I've been doing this that have gotten funded. So again, if you have questions, type them in the Q&A box. Don't chat me. I'm ending the polling right now. We have 70% entrepreneurs, 15% technologists, 10% service providers, and the rest of you are investors and educators and other. There's a lot of other. I probably need 8% other. I need to add new categories, I guess. Here, I'll share the results if anybody wants to see them. All righty. So the last thing before we get rolling, just one more housekeeping item. Idea to IPO does these events frequently. They broadcast all over the world. I just see looking at our list here, and that's why we do it in the evening. Sometimes we do it in the afternoon. But I see people from all over the world are tuning in. That's great. Thank you for being here. I want you to know that I do this probably every other week. Idea to IPO does this at least once a week, more often. But we've got some good programming coming up. I'll just give you a brief glimpse of what's up for the rest of the month. Next week on August 18, I'm going to be doing another presentation, all new content, how to negotiate with venture capitalists. You're going to want to tune in for that. I'm a little curious myself what I'm going to say, but this is going to be good, solid, practical advice. Are you ready for venture capital? Are you a candidate? How do you approach a VC? And most importantly, how do you negotiate with them? What do they want? What do you want? What should you not do? What should you do? August 25th, we've got a panel, a venture capital panel that I'm going to be moderating here, Tuesday, August 25th. That's on insurance tech. Believe it or not, that's a thing. It's a big thing. And then on September 1, we have a really good program. Like I say, this is an international organization, the largest in the world for startups in terms of meetups. And I'm going to be giving a presentation for international startups, for you non-US startups, on the issues, the special issues for you coming into Silicon Valley in particular, and the United States especially. And we've got a whole set of programming for September as well, but I don't want to give you too much. Now, we're sharing my screen. What you should see is my title slide. There we go. Awesome. Okay, Funding 101. Let's get into it. First of all, keep in mind I'm not your lawyer, even though I'm going to talk a little bit about law. None of this is legal advice. All righty. Okay, here's what we are going to talk about tonight. We're going to talk about how you and your startup and your business can get funding. I'm going to cover primarily these sources of funding, although I'm going to spend probably a little more time on angel and venture capital. What are the sources of funding? Where does money come from? Founders, savings, IRAs, credit cards, etc., debt financing, government grants, friends and family. We're going to dig into that, how exactly you get money from friends and family, or friends, family, and fools, we sometimes call it. Angels or seed investors, what sort of instruments? How do you find an angel? What kind of money can you get from an angel? What's the difference between an angel and a seed investor? Institutional money, that's venture capital or private equity. And then I want to talk about some of the alternative financing that you should not overlook. Rewards-based crowdfunding, that's things like Kickstarter, Indiegogo. Jobs Act crowd financing, that's selling securities online. Believe it or not, there still are ICOs, STOs, and IEOs. You know what those are? Those are initial coin offerings, sales of tokens, done a bunch of them. And then finally, royalty financing. So let's start with some numbers here. This is some data from Fundable. It's a little dated, I admit it, but it's still illustrative. These numbers have changed a little bit, but where do startups get their money? Early stage startups. Quite a bit of it comes from personal savings. So let me I'm going to get into this in more detail later, give you some practical advice. But you'll see that number is really big, bigger than you might have expected. Quite a bit comes from friends and family. And then notice venture capital and angel money for early stage. This is early stage companies is about the same. Banks, believe it or not, will actually fund startup companies sometimes. And then finally, crowdfunding. The crowdfunding number is bigger today than what it is now. Crowdfunding has had a resurgence in the last year. I don't know if it's a resurgence. What's the first surgence? It's had a surge in the last year, and I'm going to tell you why in a little bit. It took a while. It took 8 years since the Jobs Act for crowdfunding to get its legs, but it certainly has done so, and we'll talk about that. All right, founder money. Yeah, a lot of startups rely on personal savings. So this is a tricky thing because I get this question a lot when companies come in to see me. So keep in mind, I'm a lawyer, so I'm going to give you and by the way, there's not a lawyer in the world that can tell you what will happen, but a lot of lawyers can tell you what might happen. And I'm going to tell you what might happen when you tell me you're going to mortgage your house or go into your retirement plan. I'm going to lay some statistics on you and just how unlikely that is. And I may introduce you to some angels who will tell you that if you put money into one startup, no matter which one, you're going to lose your money. And you as a founder, just keep in mind, you're investing in one startup. The odds of you losing your money are extremely high. Don't invest more than you can lose, no matter how good it is. I'm an angel investor myself. I only bet on sure things, and trust me, I see a lot of them. I see more deal flow than any VC. I only bet on sure things, and 90% of the time they don't work out. So what chance do you have? Just keep that in mind before you put money in. You're taking a huge risk. Now, having said that, you're going to have your own money in your company. You're just going to have to. Somebody is going to have to take that leap of faith. Somebody is going to have to get to that first minimum viable product. Someone's going to have to get to the point where you can show proof of concept. Someone's going to have to put a little bit of money in to get your company incorporated. If you have questions, just put them in the Q&A box. If it's something I need to know now, type it in the chat box. Somebody is going to have to take that leap of faith and get you launched so you can get in front of an investor with something other than a PowerPoint and a concept. I have a lot of companies that come to me and they say, gee, here's my PowerPoint. Can you introduce me to your pal over there at the White Shoe Venture Capital firm? And the answer is no, I can't. They'll laugh at me. You've got to be further down the road. I can't even introduce you to an angel. So just be prepared that you have to have a little bit of money, but not enough that you can't afford to lose. Don't do anything crazy. All right, debt financing. We're not going to spend a lot of time on this because you're not going to be a candidate for debt financing anytime soon. Let's just be honest here. You're not going to get bank debt unless you've got either security or if you can personally guarantee that money. Ideally, you don't want to do either one because that means you're putting some real assets at risk. You want to invest early on only what you can afford to lose. You want other people, OPM, other people's money to take the big risk. But nevertheless, I want to let you know that debt financing is out there. Banks will loan if you've got security. They'll loan if you've got a guarantee. In fact, these days, if you get an SBA loan, if you get a paycheck protection loan, you don't need to give a guarantee or security. You can even go to the government to get other types of loans that are available. We do a whole hour on, in fact, you'll see a recording of a whole hour on this that we've done for Idea to IPO if you want to learn more about government grants and government loan process. But in the short term, in the meantime, I would invite you to just take a look at these 3 links, take a look at these sites, see what's out there. You'll be very surprised at how much SBA government is available. You'll be very surprised how much grant money is available in places that you might not expect. But think about it. What's the social good in your startup? What's the social good in your company that some federal or state agency might take an interest in? And if you can't find it, what is it about you that somebody might take an interest in? Take a look at Silicon Valley Strong. They'll list several sites. Silicon Valley Strong website, several sites of government money for companies that really the qualifying factor is that you might be in the right demographic, you might be in a disadvantaged area, you might be a minority in a minority program, something like that. So this is non-dilutive financing. It is the cheapest money you're going to get. You don't even need a customer. So definitely check it out. I'm not going to talk much about that tonight other than to alert you to, because like I say, we do a whole hour on this. You'll find it on the Idea to IPO YouTube site. You'll find it on the Roger Royce YouTube site if you want to watch that program. Email me if you want the slides. Okay, so let's move right along here because we don't have a lot of time and I've got a lot of slides. We're 10% of the way through. Where does that money come from? Well, 38% of startup founders raise money from their friends and family. You must have an uncle that's willing to put a little bit of money in. Now, this is not big money. Again, this is not money that anybody can't afford to lose. It's small money from people who believe in you just because they've known you a long time, or something like that. But 40%, according to one metric, raise money from their friends and family. How much did they raise? Not much. Not much by one metric, $23,000. Now, by the way, I'm going to give you a lot of statistics tonight. Take it all with a little bit of a grain of salt. All you can say about my statistics is that they're directionally accurate. If you want to know why, read the book, How to Lie with Statistics. The trouble with this statistic is you have to ask founders, and they have to give you honest answers, and they have to be the kind of founders that are going to respond to these questions. So these numbers may be off. Just keep that in mind. But I do believe they're directionally accurate. So I think it is directionally true that most startup founders are going to raise money from friends and family. Who's going to get you to that next stage? Who's going to get you to actually having a proof of concept? Secondly, I think 23,000 is a little low, but nevertheless, I think it's probably in the ballpark of what you can expect your family and your friends to actually put in on average. You're going to have some people do more and some people do less. But I mean, don't anybody send me a competing survey and argue with me about the numbers. I'm just telling you this is illustrative. Let's talk about angels. I see that we had some angels join us now who are a little late, but that's all right. We're glad you're here. So there's angels, there's angel groups, and there's angel funds. I want to talk a little bit about them. Angels, of course, high net worth individuals, wealthy people. For the most of them that I know, they're out there hiding because once you find out who they are, their phone will never stop ringing. And by the way, it may seem that they hardly ever invest at all, but they invest way more than you think. It's just that they see so much more deal flow than you think. Now, if you're going to go out for angel funding, hold on here. I have a recommendation for you. If you're going out for angel funding, if you're going to talk to an angel group, if you're going to talk to an angel fund, I think you ought to know what they're looking for. Do yourself a favor, read Angel, read the book, all right? Angel by Jason Calacanis. It'll tell you how an angel thinks. It tells you how a successful angel thinks. It'll give you a leg up on what it is, how it is you want to present yourself when you go talk to the angels. An angel group is just that. It's a group of angels. Think of Band of Angels. We host them in our office from time to time. Think of Sandhill Angels. Think of Harvard Angels. Think of, there's tons of angel groups. And what it is, it's a group of people. So when you go to do your pitch, you're going to have a lot of people in the room or on the Zoom call. They're all part of one group. Oftentimes they'll pool their funds or they'll invest together as a group. And that brings us to the next stage, which is angel funds. People are doing these things online now, so you can go get in trouble and make all sorts of legal mistakes all by yourself if you want to. But that's a whole another day. We're going to do that presentation as well, by the way. But nevertheless, there are funds. They're small funds. They invest early, very early. They're comprised of angels, high net worth individuals, and they serve the function of an angel as just a pooled investment vehicle. Okay, what's the name of the angel book? It's hard to remember. Here, I'll give you a hint. It's called Angel. All right. All right. So check out the book, Jason Calacanis, Angel. Moving right along. I want to talk a little bit about strategic investors. I only have one slide on this, and I'm kind of giving you everything before we get to the venture people. Strategic investors are different. There's strategic and there's financial investors, okay? Strategic investors, you might think about as a big corporate. It's an entity that has an interest in your company that's beyond just a financial return. And I know we've got some strategics on this call, so I'm going to be very careful what I say. But here's the difference between strategic investors and financial investors. So management and control will be much different with strategic investors. And by the way, there are some smart people who say when you go to talk to an investor, you should be thinking about two things. You should be thinking about valuation, and you should be thinking about management. So management and control might be two very different things with a strategic. And the knock against strategics is that once you get them on your board, you might not get their attention. Okay, so be careful about that. If you have a foreign strategic, if you're a U.S. company with an Asian strategic investor and an Asian board member, you might have even more trouble getting their attention. That's just been my experience. Oftentimes, because people move around within the company, and your champion might not be there down the road. So keep that in mind. On the other hand, I think there are some benefits. First of all, I think you're going to have less of a fight over a lot of these control issues with the strategic and management issues, because they're not there to run your company. They're there because they want a source of supply. They're there because they want to acquire you at some point down the road. And I think you're going to do better on valuations. So feel free to argue with me if you want to, but that has been my experience. So far it all sounds really good, doesn't it? Why doesn't everybody want strategics, other than the fact that you're not going to get them to vote on something when you need them to, is the knock sometimes. Well, here's the problem. Keep in mind the strategic is in your company because they want something more than a financial return, right? They want to buy your company, or they want to license your product, or they want access to your product, something like that. So they're going to put in protections every time in your company that gives them those rights and those protections. So here's the three things that you need to watch out for with strategics. They will oftentimes ask for a right of first refusal. That means before you can sell your company to anybody else, or maybe license your IP or sell your product to anybody else, you have to give them the right to match that offer. That's death for a company. That's death. You will never get another offer. The due diligence process is just too cumbersome for anybody to go through that trouble if they know the deal is going to be snatched out from under them by a competitor. So you will never, ever agree to a right of first refusal with a strategic. They know that. They shouldn't even ask. But if they do, tell them no very politely. Instead, they might want a right of first offer. In other words, before you even go out to the market, you'll let them make an offer. That's not so bad, right? They make an offer, you turn it down, then you go to the market and sell it to somebody else. At least whoever you're going out to approach in the market isn't worried about doing a lot of work and having a deal snatched out from under them, although that could happen. And then finally, what we prefer and what I usually end up with is what we call a right of first look. It's not even an offer. It's not that we're going to give you a right to make an offer. We'll just let you know that we're in the market. And before we talk to anybody, we'll come talk to you. Okay, but we're not obligated, to entertain any of your offers. So that's an hour. We could do an hour. We could do an hour on any one of these slides, by the way. The reason I'm mentioning it is don't overlook strategics. By the way, there are a lot more of them in the market now than there used to be. When I first came to Silicon Valley in the early 90s and started doing this, I don't remember seeing that many strategic deals, and it was not really viewed as smart money. Okay, it's changed quite a bit now. All the big corporates have venture funds. They're very sophisticated. They understand what they're doing. They've all realized that this is how they get into a market. This is how they go shopping. Now, I do a lot of work in health tech. I do a lot of work in agriculture tech, and I can tell you that there are tons of strategic investors in those spaces, especially in ag tech. Think of every big food and ag company you know. They've pretty much figured out that they're not going to build that technology in-house all by themselves. They're hedging their bets. They're going out, they're buying it. One way they buy it is by placing small bets, making an investment. So don't overlook strategic money early on. All righty, I want to talk a little bit about crowdfunding. So rewards-based crowdfunding. We all know what that is. It's been around for 10 years. Kickstarter, Indiegogo, this is where you go on one of these websites, and there are many of them, and you post a campaign. And the idea behind the campaign is you say, look, give me some money. I'm producing a film, and put a little bit of money in this. I'll get a lot of you, put a lot of money in. Maybe I'll send you a t-shirt or a hat. Maybe I'll send you the product if I'm using your money to build a product. I'll pre-sell your product online. And I won't take anybody's money until we hit a certain level. So it'll sit in escrow, and then once we hit, $50,000, $100,000, then I'll take the money and you get your t-shirt or your watch or whatever it is. So this is rewards-based crowdfunding. There's no securities being sold in this. Sometimes there's not even a product being sold. The legal issues down at the bottom of my bullet points are just keep in mind you could have infringement. What if you're selling IP that's infringing? You could have false advertising. What if I mean, it's kind of like when I was a kid, I used to go to the carnival every year, and I'd walk up, and the first thing I'd see, he'd say, you know what? He says, I bet you I can guess your weight. And I said, I don't think you can guess my weight. And he said, oh, I think I can guess your weight. And all it costs you is 25 cents. And I give him my 25 cents, and then he would mess up. He wouldn't guess my weight. And I'd feel pretty good because I won. He didn't guess my weight. It took me 10 years to realize he's got my 25 cents, though. That's $2.50. Okay, be careful about scams online. So the FTC will look into these sorts of things. That's the bad. The good part, and maybe the bad, is the marketing effect. Why would you do a crowdfunding offering? Here's when you might do it. You've got an affinity sort of product, right? You've got a product people can understand. You've got a product people want to get behind. You're saving the world. It's got social benefit to it. It's something like that. And this is a way of getting the word out, generating some buzz. In fact, the successful crowdfunding campaigns, they're going to have a whole, not just a crowdfunding piece, they're going to have a whole PR piece behind this once they enter the market, because they want the world to see just how much people believe in them by all the money they're putting in. And I can tell you a lot of companies that have done that very successfully. The flip side of this is that you do not want a failed crowdfunding campaign. That's a disaster. If you have a failed crowdfunding campaign, number one, you're telling the market nobody cares about your company or your product. They won't even give you a little bit of money on a crowdfunding site. Number two, you didn't do your homework. You didn't do it right. You failed. And number three, you're telling the investors people don't like this company. So if you're going to do this, have it hardwired as much as possible. Be extremely confident. And I understand that founders, I've been working with founders and other types of mad scientists almost my whole career. I understand you have to be a little delusional to do what you're doing, to be an entrepreneur. All right. And you have to be a little delusional enough that people are going to really love your crowdfunding campaign. But stack the odds in your favor as much as you can. Get some good PR and marketing behind you. And what I mean by failing a crowdfunding is, like I say, oftentimes you'll set like a trigger. So you'll say, look, we're not going to take any money unless we raise X dollars. And if we don't raise X dollars, we give it all back. That'd be one type. But the other type is if you just don't raise any money, if you raise very little. This is public. It's out there for the world to see. Okay? It's out there for the world to see. So people are going to know how much they like you or not. Tax issues, finally. I don't want to belabor this too much. Maybe it's a gift. Maybe it's income. It's usually income. Let me just say that. I know there are other people that disagree with me. If you get 2 tax lawyers, you'll get 4 opinions. I understand. But I can tell you usually it's income, because what you're doing is you're pre-selling something. Every once in a while, you can shoehorn yourself into a non-taxable gift scenario. Not very often. All right, you got to have the right facts for that. But either way, people sometimes get whipsawed because they will generate a lot of income. You do your crowdfunding campaign, you raise all your money in December. Now you've got income this year, then you spend it in January. Now you got loss, and the next year you got a tax liability in this year, then you got a loss in the next year. Not a good result. And especially if you're in a state like California that monkeys around with its NOL carryover rules. All righty. Now we're getting into the good stuff. In 2012, we got equity, we got crowdfunding, crowdfinancing, equity crowdfunding, the Jobs Act. Here, if I recall correctly, I believe we had a Republican House and a Democrat Senate and a Democrat President. So this started out as a bill in the House that was supposed to make it really super easy, very libertarian for companies to raise money, got into the Senate, and it turned into an investor protection bill. And then the president signed it and said, what a great bill. In fact, we've got a little bit of a Frankenstein monster, and it took the SEC forever to come up with regulations implementing the crowdfunding that you know about. There are now proposals out there to make this even. There's a proposal to raise the limit for crowdfunding from 1.07 million up to $5 million. Okay, so there are proposals to make this friendlier. There are proposals to really loosen this. So the SEC, believe it or not, is really warming up under our current administration, is really warming up to the idea of crowdfunding. They hated this idea at first. That's why it took them so long to promulgate regulations. But you need to look at this, because crowdfunding the first few years, we just couldn't get it off the ground. A lot of the A lot of the sites that launched, they were non-compliant and the SEC shut them down, lots of enforcement actions. We've got a handful of really good sites up now that have really good companies. So let me just tell you what crowdfunding is and how you might, whether you should use it and how you would go about doing it. So number one, you can raise up to $1 million through, normally you got to take it only from rich people, right? You can only take money from accredited investors. That's people who were rich by 1932, 33, 34 standards. These days, under crowdfunding, you take money from almost anybody, widows and orphans. You just can't take very much, right? You'll notice it's got to be subject to some limitations, but you can take it from a lot of people. So this is crowdfunding. It's expensive. You got to go through a portal, right? Can't do this yourself. Can't do this on your own internet site. You got to go through a portal, and that's a broker or a funding portal. And there are a handful of them that are very reputable, that do this very well and know what they're doing. And there are a lot of them that don't do this well at all. And you're only, you don't want to be on a market for lemons, okay? You don't want to be on a market for lemons. You want to look at who else is on that portal and see if they've had any successes. And if it looks good, then you'll go ahead and sign up with them. The other thing, just like crowdfunding, rewards-based, you do not want to have a failed crowd financing, right? You don't want to go launch something on there because this is public. Everyone can see it and have nobody invest in you. That's a disaster. Again, it tells the market no one likes your company. It tells your investors no one will invest in it. Don't do that. So that's crowdfunding. Now, again, hardwire this as much as possible. Hardwire it. Go ahead and bring your PR and your marketing people into this if you can. Just try to make sure it's successful. And in the early days, every VC I talked to said, we're not going to invest in a company that's done a crowd financing. I mean, who wants all of those? You call them shareholders, we call them potential plaintiffs. They're unsophisticated. They probably don't know that they're going to lose their money most of the time. They're going to be constantly bothering us for information, etc. So, but in practice, I've had several companies do a crowd financing, Reg CF, and go on to do a venture round. I say that again. I've had several companies do a crowd financing and then do a venture round. Now, another path is we're going to talk about this later, is to go from crowdfunding to Reg A+. I'll talk about that later. So let me just tell you, this is something you can do. Now I'm going to give you a tip. All right, pay attention. Let me give you a tip. It's a legal thing. A lot of the crowdfunding sites will sell you what they call a safe. Talk about that in a minute. A safe is an instrument that converts into stock into the next round. It's too late at night for those of us in California to tell you why this is as a securities law matter, but that is going to hamstring you when you try to do that venture round. It's going to create real problems for you as a securities law matter. You don't want to do your financing that way. Sell something else, sell common stock, or what I've done, sell an instrument that's redeemable by the company if you have to take those unaccredited crowd financing investors off your cap table. So be a little careful about that, because hardly anybody will stop you from making that mistake. Finally, we're at 7:30. 7:33, accredited only equity crowdfunding. Okay, so back in the good old days, before 2012, we had one type of private offering that we always did. Well, we had a private offering, but one type of regulatory safe harbor under Reg D 506. And this was an exemption for non-public offerings as long as you didn't generally solicit. And that exemption is still there. We just renumbered it 506B. We now have a new exemption, which means you can take money only from accredited investors, but you can solicit, you can advertise, you can post it on your website. You can go through does anyone have a telephone book anymore? I got to stop using that example. I oftentimes say you go through the telephone book and people stop looking at me and say, what, there's a book of phones? You know what I mean. You can just start calling people at random, right? You can do that under 506C. The problem is there's some new filing requirements, but more importantly, you have to verify then that all these strangers that you've called on their telephones are actually accredited. You have to verify that. So it's kind of the good news, bad news. So the good news is you can solicit. The bad news is you have to verify. The good news is there are services out there that will do that dirt cheap. All right, so 506C, it's like a little public offering almost of accredited only crowd financing, and there's a whole industry that has sprung up around this, as you might expect. There are online venture capitalists, there are online sites, etc. Once you get to that stage where you're taking a little bigger money from sophisticated investors, this is how you can do that. Yes, we are going to make a recording and share it with everybody at the end of this. And finally, Reg A+. Well, not finally, but finally in terms of the new laws. Reg A+. So remember what I said about how a lot of companies go from crowdfunding to Reg A+. What's Reg A+? It's like a mini public offering. It's like a $50 million public offering. But don't get too excited because it's not that far from a public offering. It's still a lot of work. It's still very expensive. And it still requires ongoing disclosure. It still requires a registration with the Securities and Exchange Commission. You do this when you need $50 million. You don't do this when you need $10 million. The transaction costs are too high. More of these are being done now than before. People are finally starting to get their brains around it and getting comfortable with it. But what I want to warn you about, here's another tip, another practice pointer for you. These are expensive. These are expensive and they could fail. And guess what? If they don't work out, you still got to pay your lawyers, okay? So you don't want to do this unless you're pretty darn confident. And there are people out there who can give you those degrees of confidence. Now, where I've seen this often work, here's the strategy. Companies that have a good affinity product that people will understand and will throw $1,000 at, 100,000 people will throw $1,000 at or whatever. They'll do a Reg CF crowdfunding, raise $1 million. Take that $1 million and cover the cost for a Reg A+, up to $50 million. That is a strategy. That is a strategy and one that you might want to consider if you've got the right kind of company and the right kind of metrics. Don't do this unless you're confident. That's all I got to say, or you're going to end up spending a lot of money on fees that you'd rather not. Finally, I want to give a nod to initial coin offerings, ICOs. We don't see them much anymore. We don't see them much at all in the United States. This is really something that's been pushed offshore. 2017, I talked to everybody in the world about this. These days, not so much based on, I don't want to say blockchain anymore. That's like saying clean tech. I want to say it's based on distributed ledger technology. And the idea is that you're selling tokens. Just briefly, I don't want to spend a lot of time on it because I'm not doing so many anymore, but briefly, the concept is you do a pre-sale of a token, you raise some money, you use the money to actually build the token, and the token is just a digital asset, right? A little piece of code that ties to some service or maybe even a real world asset. I've got companies doing that. And then you go out into the market and you sell the tokens. And people have the token, they can burn them for utility, they can use it to view your videos or listen to your music or whatever. Or they can hold them. There's a concept called security token. They're tied to real, secured by some real asset like real estate usually. I've got one that does Chinese artifacts. It's doing really well, actually. The good news is these can be traded on exchanges, even here in the United States, on alternative trading platforms. So it's a possibility, and it's still out there, and there's still a market. The reason this isn't as big a deal as it could have been, don't get me started, SEC, they don't understand it, they don't like it, just like crowd financing, it's going to take some time for them to get used to the concept that there are people who are not crooks who want to use distributed ledger technology. And plus the law just has to sort its way out. Hopefully we'll get a safe harbor at some point that'll make things a little easier. All right, and before we talk about venture, I want to talk about royalty financing. Finally, because I'm seeing more and more of this. What do I mean by royalty financing? Here's the scenario. You got a company, you got a product, you don't want to sell stock. What you're going to do instead, you're going to say, look, I'm going to give you a percentage of revenue from this piece of intellectual property or this movie, right? Or this product that we're going to sell or this whatever it is. So instead of giving you stock in a company, you get X dollars right off the top every time I sell a piece of it. Royalty financing. I'm seeing more and more of it. It's very creative. It works. It is a thing. What I want you to keep in mind, though, is that your next investor, your equity investor, they're going to view that as debt, right? And what I mean by that, they're going to view that as something that has to be paid before they can get paid. All right. It's on your balance sheet. It's a negative, right? You can't squash it. You can't reshake it. You can't convert it to common. You know, I suppose you could if you get everyone's consent, but for the most part, it's debt. So it's expensive money in that sense. It's not expensive in that you're not giving up equity. It's expensive in that you've got something sitting on your balance sheet as far as the investor is concerned. So something to consider, but it's got its drawbacks. All right, we are at 7:40. I want to talk about venture capital. Now, first, let me say that some of my best friends are venture capitalists, but this is a business. So 10 years ago, I still read a lot of blog posts, and I throw them up there online, and I'd get 10 views here and 20 views there, and maybe 100 views if I was really hot. One day I wrote a blog post called Why Venture Capital is Financing of Last Resort. And I got thousands of views. I got hate mail. I had people that went to the trouble, you know, to stop what they were doing, go find my email address, and then send me an email telling me how all wet I was. But the VCs that I talked to, on the other hand, if they're honest, and if they read my article instead of just the title, they would have agreed to me. This is very special kind of financing, very unique kind of financing. You're not a candidate for venture capital, and we're going to talk a lot more about this next week, unless you're one of those go big or go homes that you need a lot of money really fast to get your product developed and get it into the market before the next guy does. You need a lot of money for marketing. You need to get a lot of eyeballs on your product, and you need it fast, and you're willing to pay venture capitalists to do it. Most of the companies I work with are in that category. Okay, I have very few at this point in my career. I have very few yogurt shops anymore, but I have had them, by the way. I have, very few companies like that. I do, on the other hand, work with a lot of tech startups that they're either going to raise that venture money, and they're going to do it pretty darn fast and get into the market, or they're not going to go anywhere at all. If that's you, then let's talk. Okay, let's talk. Here's where we are in terms of the market. I've only got numbers through Crunchbase, through Q1 of 2020, but given all that's going on, they look pretty strong. They're not going to be as strong for Q2, obviously, but anecdotally, I will tell you that there's activity out there and things are happening, and I'm still doing venture deals almost every day. Valuations are down, anecdotally, I will tell you. Some people are panicking. Other people are seeing opportunities, and for other people, they're still off on their summer vacation, I guess. But venture is still strong enough you should pay attention to it. It's still doing well, and it just has to. It just has to do well. There's too much dry powder sitting out there, sitting in funds. Now, what you're going to hear a lot of people talk about, the Black Swan memo of 2008 and how this is like that. I did a bunch of panels on that with venture capitalists. It's not true. This is nothing like that. In 2008, the biggest funds in the Valley were giving money back to their investors. They're saying, we're not even going to take your money. We're not going to invest that. They're not doing that now. In fact, I'm forming new funds. Okay, people are optimistic now. The recession that we know is coming and we have known for a long time, some of us, me, expect to be short-lived and shallow. By the way, short-lived, not short-lived, but short-lived and shallow. That's what we expect, notwithstanding what's going on. So that's what I'm saying, and even though you won't hear a lot of people say that, I feel like they're voting that way with their dollars because I think the economy is still relatively strong, given all that's going on. Here's some more numbers for you. Globally, okay, we've got to change. We've had some changes here year over year. It's going down, but it's still relatively strong. It's still a lot of money that's out there, $22 billion. Projected technology growth investment, down but strong, all right? Late stage investment, that's probably not our audience here today, but you can see, strong. Late stage round size, the average is up 6%, year over year, median's up 7%. Here we go, early stage round size, okay? Average is down just a little bit, median's up way up. By the way, read my book, not my book, but the book, How to Lie with Statistics, if you want to know the difference between an average and a median and why those numbers are so far off. But directionally, what I take away from this is there's still an industry. It's still strong. It's still something worth pursuing. Let me jump ahead here. I want to, you can visit these statistics at your leisure. What I want to talk about is a little bit more of the nuts and bolts of venture in the last 50 minutes I've got, because this is going to be a good introduction to our presentation next week when I talk about how do you deal with a venture capitalist. So let's assume that, and I'm not going to spend the entire time on this, but I do want to set this up. So should you take venture capital? So number one, you got to give up equity. Equity is the most expensive financing there is, right? Doesn't sound like it, but you know, if your company is successful, you know, the venture capitalist makes way more return than a debt investor. Obviously, otherwise they wouldn't do it. When would you do it? You would do it if you don't have the cash flow to pay any debt. Because if you could take cheap debt, you would do that, especially today. It's interest rates at 1%. You're a risky business. It's illiquid for venture capitalists. Like I say, we need to know that your business can scale. Otherwise, you're not a candidate. Don't do it. And here's something else. Huge market, right? Huge market, right? Venture capitalists are not interested in a small market. Just don't even bother. They need to see a huge. Now, it might not exist, right? When Airbnb got financed, there was no market for what they did, right? Same with Uber. It might not exist, but the market that you in your entrepreneur, founder, semi-delusional state can imagine and can paint that picture has to be huge. Has to be huge. So show me the market. I didn't put it on here, but because we're going to talk about it next week. But team, when you go to see the VC, just keep in mind. I know you think you've got no competitors and nobody can do what you can do and nobody has done it. That's not what they're thinking. They're thinking if these guys can do it, maybe someone else can do it. And if someone else can do it, maybe I could find a better team. So, you know, you want to convince them not only in your idea, but you are the best possible people in the world to execute on that idea. We'll talk more next week about that. You should know a little bit about venture economics. They have to make tons of money. This is why. We have a whole presentation on this. You can find it on our YouTube channels on venture economics. We're going to talk more about it next week as to exactly what it is they want out of you. We'll go through the math, but just expect them to look at you and say, I need to get 2.5 to 3 times my investment return on all my investments. So I have to earn 3 to 4 times my investment to return that to my LPs. So how much do I have to make on you? Let's use an example. Here's venture capital economics. You got a venture fund. They've got enough money to invest in 10 companies. They've invested in 9 companies. And let's do the math. Let's say they've made, you know, they've broken even on half of those and they doubled their money on the other half. How much money do they have to make on you, right? They will have to make a home run on you. That's what they're looking for, right? They're looking for a home run. Here's another way of looking at it. If they make 100 times their money on you, how much do they have to make on all their other companies? And the answer to that is it doesn't matter. All right. So they're looking for home runs. That's what you're selling to venture capitalists. So are you that kind of company? I don't want to belabor this too much. We're going to talk more next week. We've talked about this large potential market. One thing I do want to leave you with is you really have to have traction before you can see a venture capitalist. You really have to have traction. What is traction? Well, ideally it's earnings, but it's a little more than that. It is you showing the VC that people will buy your product, right? That's what they want to know, that you've got goodwill, that you can sell 1 and you can sell 10 and you can sell 100, and if they put more money in, you're going to sell a lot more. That is my definition of traction. I'm going to skip over some of these terms because this is all of next week. And let me just talk a little bit about, rather than venture terms, what kind of company you want. And this is for angels as well. So here in Silicon Valley, I told you, you know, the occupational hazard is I'm a lawyer, so I'm going to talk a little bit of law. A couple of things you need to know going into this, know these terms. we'll not talk about the business model today. What I do want to talk about is choice of entity. 99% of the companies I form for venture capitalists in Silicon Valley are Delaware C corporations. I'm a California lawyer. I'm sitting in Silicon Valley. 99% are Delaware C corporations. If you're not in Silicon Valley, a lot more of them are going to be limited liability companies, okay? And there's reasons for that. But if you're going to see a VC, you're going to be a C Corp by the time you get there. The strategic might not mind. You can actually do an LLC deal with a strategic sometimes because they want the tax flow through. But for VCs, for a lot of reasons we don't have to talk about, they're not going to invest in you unless you're a C Corp. So that will usually be your choice of entity. There's another reason for that. And this is if you're talking to angels, not necessarily VCs, but oftentimes VCs, is this thing called qualified small business stock. Qualified small business stock, go Google it. It's one of the biggest assets you have to sell when you're talking to investors. If you're selling stock in a qualified small business, meaning you're worth less than $50 million, it's originally issued stock for cash or property or even services. If it's in a business that's not really a services business, it's an active trader business as defined, broadly defined. If that's the stock that you're selling, and that's what you, the founders, are buying, as well as the investors, even though they might get preferred and you might get common. If the holder of that stock holds it for 5 years, when they exit and sell their stock, they can exclude from federal taxation, not state in California, but they can exclude from federal taxation all the gain from the sale of that stock up to $10 million or 10 times their cost basis. So think about that. You're an angel investor. You buy this stock, you hold it 5 years, it's a big home run, it succeeds, you make $10 million on the deal, you pay 0 federal income tax. That is a huge giveaway. It's a huge benefit. We don't know how long it's going to stick around. Someone's got to pay for all these government giveaways lately, but it's there now, right? Not for California purposes, of course, but for federal purposes it is. And that is a huge selling point. It's something you really need to know about. You need to be able to talk about. You need to be able to tell people, yes, we are a qualified small business. You invest in us and you get one heck of a return if we're successful. Second thing you should know about is what a cap table is and how a cap table works. And by cap table, it's just a summary. You want your cap table in place as soon as possible. For most of you, this means you got to form a company and you have to issue shares to people as soon as possible. You want that company to start gathering up all the intellectual property in one place inside the company, and you want your employees and consultants to be tied to that company. Your cap table is going to show who owns what they own, what percentage they own. The reason you want that cap table, set it up in Excel so you can do what ifs, so you can strategize. In fact, today I spent the afternoon going through cap table trying to figure out, what if this person votes with me? What if that person doesn't vote with me? That kind of thing. Who's going to control the board? Once you get into later rounds of financing, you'll find that the people who planned ahead on their cap table and did those what ifs and strategized are going to be way ahead of the game. Vesting, get used to it. Your shares are going to be subject to vesting if you're a founder. Don't even argue about it. And there is this cruel joke in the Valley called 4-year vesting. It's not going to be 4. It's going to be almost the life of the company typically, because every round of investors is going to take a hard look at your vesting schedule and decide if they want to unvest you. We'll talk about this next time. The point of this slide is, manufacturing businesses have more potential upside than licensing. So think about that when you're setting yourself up. We talked about choice of entity. We talked about advantages of C Corps. We talked about qualified small business stock. All the detail is here in these slides. I do want to just kind of jump ahead to a couple of kind of startup basic things now in the last 5 minutes that I have. So again, this is funding 101, but it's going to be really important that you position yourself to get that funding. So let me just leave you with 3 things in my time that you need to position yourself. Number 1, get your equity right, okay? Get your equity right. When you go talk to the investors, again, they're looking at team. They're not only going to want to know you've got the right team, they're going to want to know that your team is properly incentivized and they're going to stick around. There's 2 ways they're going to make that happen. Number one, the team member has the right percentage, right? So you're not giving somebody too little of the company for their contribution. And oftentimes in what we call a subjective approach to splitting up equity, you see that happen because it ends up being a matter of whoever can pound their shoe on the table the loudest is who gets the largest equity stake. And that works really fine until you go talk to the investor and they see that it's out of whack. So one is get the equity stake right. How can you do this? Most companies do it just equal percentages. It's probably terrible, but it's what most people do. Other companies use a formula. I like that better. And there is something called a dynamic split formula that would take me another hour to explain, but it will give you the best result. Go online, check out the site, slicingpie.com, slicingpie.com if you want to see that. That's one way, get the equity split right. And by the way, once you do it, you're kind of stuck with it. So get it right. You're married. It's worse than being married to your founders because you really are stuck with them until that company's gone. Second is vesting. Vesting is a concept that you earn into your shares. So if you're a service provider, you get shares. You leave the company, your unvested shares go back to the company at cost, which is going to be close to nothing. That's vesting. Like I say, in this valley, founders will start off with 3 years, thinking that they're going to stay with 3 years, sometimes 4 years, depending on the company and who the founders are. The investors come along, they oftentimes will reset that 4 years or 3 years, but that's what you should expect to start with. How about other service providers, speaking of which? Advisors. Now, this is a little bit controversial, but I'm going to tell you that advisors are a good thing for your company. Advisors are a very good thing, right? If you get the right advisor. Advisors, you should give them equity. It starts at 0.25%, goes up to 2%. Take a look at Dale Russi has got the FAST model that he developed over at Founders Institute. It's online. It gives you a little graph that can show you how much stock you should give to an advisor based on where your company is and how much contribution you can expect from the advisor. That's how much equity they should get. So here's the 3 things to know about advisors. Number 1, they should be paid in stock, never cash. Number 2, you should have milestone and deliverable-based vesting, never just time-based, because you want stuff from them. And that's number 3, the stuff you should get from your advisors or whatever it is, their particular expertise. It's not enough to be a founder. It's not something you can go out and buy like a consultant. It's something they have. They have access to money. They have access to customers. They have industry knowledge. They have some technical expertise. They have domain expertise that you don't have. You're in agriculture technology and you want a farmer on your board to tell you whether farmers are going to buy your little water monitor doohickey. Whatever it is, they have that special expertise. You need to pay them for that. You don't have cash. You do have stock. 0.25% and goes up from there. It sometimes goes down, also goes down depending on who the advisor is, but that's where I usually start. The currency, stock. That's what you've got. You've got stock. You've got options or you've got stock. We're not going to talk about these other instruments right now. Just keep that in mind. All right, we talked about vesting. We talked about the VC's approach to vesting. I'm going to leave you with just a couple of other things that you might have heard about. Be super careful about the stuff you read about online. I know, I hear this sometimes. I heard a lawyer one time say, well, you should do this because it must be good because Facebook does this. I got bad news for you folks. You're not Facebook, right? So you might not be able to get away with something like Class F super voting stock. I know your desire to hardwire control of the company. That's fine. I'll even help you do it as long as you understand it may not stay there for very long. It's likely going to be negotiated away in a later round. That's one thing. There are a lot of things like that you're going to find online. Be careful about it. I'm calling this one out specially because everybody asks me about it and I give them this lecture. If you really want me to do it, I'll help you do it. You know, it's not quite assisted suicide because you can fix this later, but don't get too wed to it. You might not be able to have control of your company once the vis-a-vis the other common stockholders, once the investors get involved. We're going to cover all this next week, rights of first refusal. I lied. I said I was going to talk all about safes and other convertibles. I didn't do that. We'll talk about this next week. These are the instruments that you're going to sell in order to raise that money, deeper dive. And we did talk about the cap table. So with that, we are at 8 o'clock. I am going to go ahead and open up the lines to questions. As soon as I go back to my original slide, there's got to be a way to go back to the beginning. Easy on these. One of you smart tech entrepreneurs should come up with a way for me to do that with one keystroke. All righty, let's see. Let's open up. Let's see what the questions are. And I haven't even seen these yet. We've got lots of questions. The book. Thank you. I'm going to recommend 2 books to you. One I already told you, Angel by Jason Calacanis. There we go. Check it out. That's if you're talking to angels. And there are a lot of books on venture capital, and I've read a lot of them. Kind of like this one. Okay, Venture Deals, Jason Feld. It's Jason Feld, right? Oh, sorry, Brad Feld, Jason Mendelson. Check out these 2 books. If you're talking to venture capitalists, we'll tell you what to expect, what they're expecting. And if you want to know how to do things right legally, look at my book, send me an email, I'll send you a download of it. Okay, someone wants to know if they need a license to sell stock online. Yeah, let's talk a little bit about that. So the answer is complicated. So I'm going to, oh geez, sorry, I didn't have my lamp on this whole time. The answer is complicated. So because I'm going to take that in a few different directions. Let me talk about the one thing that I want you to know as an entrepreneur: finders and brokers. So there was a time here in Silicon Valley when there was a finder behind every tree. And if you couldn't get money on your own, I'll tell you what, I'm going to stop share. There we go. All right. Do you see me or do you see Rob? If you can get money on your own, what you did is you went to a finder, and the finder would go shop your company up and down and around town, and they'd take a percentage, usually like 6%, sometimes up to 10. If it was big money, they'd use a Shearson-Lehman formula and take 3, 2, 1, whatever it is. You'd use finders for that. The SEC has really cracked down on that. In order to do that, they have to be a registered broker-dealer. All right. There are still, believe it or not, a few people that don't know that. They're usually not from Silicon Valley. And they come in and they say, look, I can go find some money for you. You just give me a percentage of what I raise. Maybe I'll do it online. Maybe I'll just do it through my connections. Either way, that's a broker-dealer. They need to be registered in order to raise that money for you. You can go online, you can go on a government site, the SEC has a site, and you just type in their name and find out if they're a registered broker-dealer. Why do you care? Here's why you care. Because if somebody does, if you do take money from somebody through an unregistered broker-dealer, they have a right of rescission. So even though your company fails, you're going to end up writing them a check back. You're going to pay them back. You don't want that to happen. That's a bad result for everybody, right? Secondly, the finder himself is not entitled to keep any of the consideration that they made. They'll have to give that back as well. So that's one piece of it. Now, getting back to your question, going online, what that is, that's a solicitation. And these days you can sell stock online as long as you qualify under 506C. Remember we talked about 506C? What this means is that you will vet everybody and make sure that all of your investors are actually accredited. I've said accredited 10 times tonight. I haven't defined what it means. An accredited investor, if it's an individual, it means a person who passes either a net worth or a net income test. They either have a net worth of more than $1 million, excluding their personal residence, right? Or they have a net income of $200,000 a year for the current year and the prior 2 years, $300,000 jointly. All right. They have to pass one of those 2 tests if they're an individual. If they're an entity, a company, they either has to have $5 million of net worth in the company, or assets in the company rather, or all of the owners of the entity have to be accredited. Now, there are a bunch of other exemptions. Directors of a company are accredited with respect to that company, et cetera, but that's the general idea. So, so if you go online and want to raise money on the internet and advertise your company, that means you can only take money from people that you verify are accredited. That means you got to look at their tax returns. You got to call their banker. I don't know, get a note from their mother or something like that. There are services out there that will do this for you. But that's the tricky part. So the answer is yes, you can. Use the Q&A box if you have questions, just to kind of help me stay organized. Somebody wants to know about why they would form a company in Delaware. Why Delaware is the jurisdiction of choice. So many reasons, so many reasons. And the more I use it, the more I like it. I was just reading yesterday all the new laws Delaware. I believe it, Delaware has already passed a whole new set of corporate laws to respond to COVID. California has been doing it by executive order from the governor, but it still hasn't caught up. Some of them don't make any sense. But Delaware is so on the ball. But that's a good reason for using Delaware. It's not why you should. The real reason you should is because if you do get the venture stage, the investors are going to insist that you be a Delaware corporation for a couple of reasons. The biggest reason is you can what they call aggregate class voting in Delaware, so that the investors can vote as a class with all of the other stockholders on a sale of the company. In California, you couldn't do that. A California corporation, you'd have to get a majority of the common stock and a majority of the preferred stock to vote for a sale of the company, so the common could block a sale. And when you have, especially when you have troubled companies, when you have a sale of the company that's not going to give the common, a lot, you might not have the dynamic that you want. So the other reasons is that the Delaware Secretary of State is just so easy to deal with. They don't have peer review. You can file stuff there. So Delaware has just been the jurisdiction of choice. The other reason is their fiduciary law is just so well established and so clear cut. And I got to be careful what I say because I'm a lawyer licensed to practice law in California. I'm an officer of the court. I can't say anything bad about California. But I will say that Delaware is generally viewed as relatively easy. Courts there will enforce the laws as written, whereas a lot of people from out of state, they view our courts in California as being a bit more activist, meaning uncertain as to what result they might get. If you don't believe me, just go ask O.J. Simpson, if you're old enough to know who that is. What else about Delaware? That's enough about Delaware. Just trust me, do Delaware. All right. What causes companies to fail? So, it's like a salmon swimming upstream. There's just so many things working against a startup company. Everything has to be just exactly perfect. And the question is, what caused my 90% sure opportunities to fail? I mean, I'm embarrassed now to tell you looking back on it, because why didn't I see that before? Didn't do my diligence, I guess. Oftentimes, here's a big one that I look for now, is the founders, they either better get along really well, or there better be some mechanism in place for when they don't. One thing I will never, ever, ever, ever do again. I don't care who it is. I don't care if it's Facebook reincarnated. I'm not going to invest in a boyfriend-girlfriend startup. Never again. All right. You know how that's going to turn out. All right. So the team has to stay together, or we have to have something in place for if they don't. Number two is technology risk. I don't think, okay, flame me if you want, but I've been around long enough to tell you that the best technology doesn't win. It's not the better mousetrap that wins. Silicon Valley does not pick the best ideas or the best products. They just don't. That's not the one that wins. Usually it's the one that's marketed the best that wins. So, but nevertheless, there is such a thing as technology risk. And I've seen companies that just could not do what they said they could do, Theranos, and I'm not going to mention any of them. So that's another reason that companies fail. So technology risk is a second one. And then a third one, and this is the number one probably biggest thing, and this is the hardest one, is just timing. So let me give you, because I like to be positive. I think we should be more upbeat about this rather than talking about all the dead on arrival mistakes that could kill your startup. I'm going to give you a little bit happier story. 10 years ago, I was working, well, better than that, 20 years ago, I saw Facebooks before there was a Facebook. I saw people doing exactly what Facebook was doing. Timing was right. I saw people put millions of dollars into these companies. Timing was wrong, rather. They just didn't hit it right. Now you'll say, well, it's because of the team and because of, but maybe, but I think it was timing. 10 years ago, I saw a lot of clean tech go down the drain, right? Good ideas, good companies, save the world technologies, all this good stuff. Cheap energy, available, affordable. timing was wrong. You know how I know timing was wrong? Because I see those companies back right now. And now people are thinking, instead of thinking about clean tech, the consumer is more socially responsible and are thinking about climate tech. So now all of a sudden, short well geothermal is a really big thing. Those companies are making money. I remember the first company that ever did that. I loved it. It was brilliant. It was a great idea, but I knew no one would buy it because who cares about saving the world? But now, I mean, the timing was wrong. So I think timing is the other big thing. You see really great companies, great ideas, but you just got to have that sense of the market. If you're a millennial, you've probably got a real head up on it because you guys can see the future better than I do. All righty here. How to deliver an effective pitch to angels, especially for tech startups. Read the books that I sent you. They're going to tell you exactly what those angels want to hear. Just do your homework. Do your homework and understand what they want to hear and also what they don't want to hear, what they don't want you to do. I'll give you one for free out of Jason's book. Don't lie, okay? Everybody lies. I know, everybody puffs. Everybody has this wildly optimistic view of the future. I do too. I started my own law firm 15 years ago in a recession. Just me. I was a startup entrepreneur as much as any one of you. I had this wildly optimistic view of the future. By luck, it came true. But there's a difference between that and actually lying. And sometimes people will lie about how many customers they have and who's a customer and not tell you whether they're a paying customer or not. I see that over and over again. You're going to get found out. The sophisticated angels will find out. The dumb ones will be mad at you. Just don't do it. Why do Asian entrepreneurs confront more difficulties with strategics? No, that's not. Sorry, you misunderstood me. What I was saying is that I find that, and this has nothing to do with Asia, it's just foreign, but I find that foreign strategics that are on your board are a little harder to deal with, or they were before COVID because it's just so hard to communicate. They're in different time zones. Someone's got to be up in the middle of the night. They don't show up. You get big boards. Sometimes you don't hit quorum. With Zoom, it's a lot easier. It's a lot easier to have investors in Asia or other parts of the world. Passion for product or service, how does that fit in with getting funded? Well, I would say more, whenever I hear people have passion for their product or service, I just think of romance novels. So I don't like to phrase it that way. Instead, I would say good product market fit. It's probably more important when you were talking about product or service. And also domain expertise, an entrepreneur who understands the product and understands the service. You'd be surprised. I mean, I've seen pitches where entrepreneurs did not even understand what they were selling. I saw a company that had an online real estate platform that was illegal. It was just illegal. It was illegal under real estate laws in every state in the country. They didn't know that until I saw them pitch it, and I had to tell them. All right, STOs we talked about. That's security token offerings, is that what you mean, security tokens? Let me talk about security tokens because I don't think it's dead. I talked about ICOs, it's initial coin offerings. There's another thing very related. It's based on blockchain or distributed ledger technology. It's called a security token. You have a real world asset. I have a client, I'm not speaking out of school telling you this, I know they'd want me to. They have Chinese artifacts that they have tokenized. So, and these artifacts are worth hundreds of millions of dollars, sometimes tens of millions anyway. They're very, very valuable, but who can buy them? Who's got that kind of money lying around, right? You can buy a little piece of that Chinese artifact. You buy this digital representation of that artifact and you can buy and sell it. You can trade it. You can exchange it. If you think the value of the artifact is going to go up, you can buy or sell your token and that'll go up. That's an STO. I think it's a real thing. There's a whole industry around this. You can do it yourself. You can do it online. You can do it through services at a law firm. By the way, the other thing in this I like about this is the initial exchange offering, where you just launch the sale of your token, whether it be a security token or not. On the exchange, you've already got vetted investors. You've got your KYC, that's know your customer. You got your AML, that's anti-money laundering. All that's taken care of. The compliance is taken care of. All you have to do is just sell your tokens and they take care of everything else. Please elaborate on how illiquid ties into the venture capital slide. Yeah, I didn't do that very well, did I? What I'm saying is that venture capital investments are illiquid, all right? And your stock in that company is going to be illiquid also. Illiquid means you can't sell it. Now, why can't you sell it? I'll give you a couple reasons. The practical reason is because the VC does not want you to, right? They want you to be tied to that company to the bitter end. They let you sell your stock and exit. Who's going to stick around and run the company? So they're going to tie you up to it. The legal reason, because you don't own it if you don't have the right to sell it, and that's not going to do anybody any good. So legally, the way this happens is through a combination of transfer restrictions. There's 3 of them. So right of first refusal in favor of the company, a right of first refusal in favor of your investors, and thirdly, a co-sale agreement. What that means is, let's say you decide you want to sell some stock in your company because phooey on the illiquid stuff. I need money. You heard my song at the beginning, right? Money is what I want. Suppose money is what you want, not stock. So you go find a bigger sucker. You go find a buyer, and you say, hey, you want to buy some of my stock? And they say, yeah. Then you go look at your documents, and it says you have to offer it to the company first. So let's say you got a buyer that's willing to live with that. Say, okay, I'll give you $1 a share. And they say, okay, I'll be right back. And you go to the company and say, I've got an offer of $1 a share. Do you want to buy it, or can I sell it to the company? The company says, no, not right now. I don't think we're going to buy it. But you know what? Now you have to offer it to the investor. So you go to the investor. You go back to your buyer and say, wait 1 minute, I got to talk to the investor. Investor, I got an offer to sell my stock for $1 a share. The company doesn't want it. Do you want to buy it? The investor says one of 2 things. They say, yes, I will buy it, in which case you're a third-party buyer. They're out of luck. Or worse, they say, no, but I'm going to exercise my co-sale right, which means that not only does your buyer have to buy your shares, they got to buy my shares too at the same price. All right, so that's just one of a million ways that your stock's going to be locked up. Okay, so just keep that in mind. Keep that in mind that stock gets locked up a lot of different ways. All right, somebody says VCs are wrong 50% of the time. Why is that? I think you're being awfully generous to the VC. These are extremely high-risk investments because they have extremely high-risk returns. There's just so many things that have to happen all at the right time for them to hit. But when they do, they hit big. So I wouldn't say that they're wrong 50% of the time. I'd say the good ones are right 10% of the time, if they're lucky. Have you seen startups utilized by micro hedge funds to get started? No, I don't even understand the question. A hedge fund typically invests in liquid securities so that they can get some liquidity and buy and sell, and that's the opposite of what a startup is. By the way, there's a regulatory reason venture funds are designed to follow a venture capital strategy. So that's what they invest in. Some of them will put a little money in crypto, but no more than 20%. So it's an industry, it's a strategy, it's startup focused. You rarely see the two combined. Question: how do Silicon Valley VCs or angels feel about, investing overseas? If the investor does not like to invest outside the U.S., what's the right way to get funding? I'm from Europe. What's your name? Anonymous. Thank you, Anonymous. I'm glad you asked that. That's a really good question. The Silicon Valley VCs and angels feel way better about investing outside their neighborhood today than they did before, in the right sector, if you're in the right sector. Now, I got to tell you, here in Silicon Valley, we're really spoiled. We got the catbird seat. Everybody in the world wants to be here and will be here at some point. I know a lot of you are not from here, so let me tell you what it's like. Let me tell you what my day is like. I get up in the morning, and I live in Menlo Park, and sometimes I'll drive down Sand Hill Road on my way to work. It's a 1.5 mile stretch of road. I went for a jog there last weekend. I jogged past $50 billion worth of venture capital, probably, right? Half the venture capital in this country is here in the Bay Area, right? Tremendous amounts of money. Number two, I'm here in Menlo Park. Facebook is next door to me. They're all remote, sheltering at home, but you get the idea. Google is down the street in Mountain View. Microsoft is in Mountain View. Adobe is right up the street. They're in San Jose. Oracle is right up the street in Redwood City. Citibank has got a big office. I mean, everybody is here. Everybody is here, right? That's the point. So that's Silicon Valley. And number three, there are some really smart people here. I don't know how I managed to find my way in because there are a lot of technologists here. There are a lot of scientists. Stanford University is right down the street. There are a lot of smart people here. There's a lot of talent. So because of that, we have a real rainforest. A friend of mine, a venture capitalist, ran a book called Rainforest. It's how to create the next Silicon Valley. We have a rainforest of opportunities here, and that's why there's so many great startups. So if you're an investor in Silicon Valley, you're not really incentivized to look around too much, but sometimes they do. Sometimes they do. If you're in the right company, if you're an agriculture technology company, investors located here will invest in you, even though you're in Iowa, or maybe even in, even in Asia or India. So now, if you're not, if you're doing enterprise software, if you're doing social media, if you're doing, something that's in a crowded field, or there's a lot of investors, or there's no local advantage to being where you are, then you're going to have to be a Delaware corporation to get funded. We do this transaction, we call it a flip transaction. We take your Lithuanian, whatever it is, and we turn it into a Delaware C corporation, and we go see the VCs. You can say, yes, we're a Delaware corporation. Of course, you're going to have to establish an office here somehow, but at least you've got the right structure. There's a way to do that. We do it every day because probably half the companies I deal with are from outside the country coming into this valley. How can a founder stop himself from being ousted from the company after VC funding? You cannot. Just plan on it. Plan accordingly. Negotiate a severance package if you have to. Negotiate. We didn't talk about double trigger acceleration of vesting. We're going to talk about that next week. But there are things you can't protect yourself from being kicked out. Okay. Series A, you won't lose control. You'll have 2 or 3 board seats probably. You'll be able to keep yourself in as founder if your co-founders like you. Series B, you're going to lose control. Promise you. Even earlier if you're a biotech company. At that point, you might get fired from your position, and that means you lose your vested stock, and you're kicked off the board, and bye-bye my company, my baby. And it's a rare founder that sticks around in a company till the end of its life. It's not very many companies. Rare is the Bill Gates, and Zuckerberg and those guys. So just plan accordingly so that you get some accelerated vesting. And for Christ's sake, get your own lawyer to do this. I've seen so many people come in here that relied on company count. Go watch the Facebook movies, Social Network or whatever. So many founders have come into my office saying, I relied on company counsel to protect me, and now I got nothing. Get your own lawyer, make sure you've got protections. We're going to talk all about this next week. Thank you. That's a great lead in. I should have ended with that question. All right. Somebody gave me some answers. They said the number 1 reason for failures is product market fit. Number 2 is running out of money. And number 3 is team. Can you give me a list of VCs in the Bay Area? They're not hiding. Just go online. Do you work, how to start an organization with a non-U.S. citizen? Yes, we do presentations on that. You'll find it on our YouTube. In fact, we just did one last week on immigration for startups. You'll find it on my YouTube channel. All right, let's see. Follow-up question. How do we improve the VC's choices for investment? How do you improve your chances to get investment? Come see me next week. That's what we're talking about. Okay, would a company in California consider investing in a company in Austin? Again, if you're an ag tech company, yeah. If you're a health tech company, probably. I've had that happen. So if you're the right kind of company, Austin is not so far away. I like Austin. They used to have a big music scene there, some fun bars. I would invest in an Austin company if it was the right one. All right, what else do we have? We've got 5 minutes left. So here's one. When is a good time to incorporate a company? Idea phase, prototype phase, minimum viable product phase. Here's my answer to that, since we're getting towards the end of the time here and the end of the questions. You want to incorporate as soon as possible. Okay, and the reason why is you need to get it in writing. There's 3 things you need as soon as possible. You want to split up the equity among you and your founders. Okay, if you don't have it in writing, as far as I'm concerned, it didn't happen. It's just your word against theirs. right? So number one, get that in writing as soon as possible before people's minds start to change and their memories start to differ. Number two, you need a vehicle to start collecting the intellectual property that you're developing. So if you get a vehicle, you can get a good standard form of confidential information agreement and invention assignment that you can have everybody who touches your idea sign and assign that IP to your company. You can start, protecting your trademarks. You can start using your marks. If you've got patentable product, you can get that process started. You get a vehicle to start building this huge intellectual property asset of yours, as well as the goodwill asset that you're building. You want that in a vehicle that everybody owns a piece of. You don't want 20 people co-owning your IP. We could do an hour on that. That's just such a disaster. Thirdly, you want to have a mechanism for when things don't go well and you start kicking founders out. Now, let's say you have a founding team of 2 people. Okay, that might be okay. If you have 3, my experience is I'd say there's a 50% chance that one of those 3 is going to be gone within a couple of years. If you have more than 3, it is a huge chance. It is a much bigger chance. Somebody for sure is. If you have 5 co-founders, someone for sure is going to be gone within a year. So you want to have a way to get the stock back. You need vesting restrictions. You need an entity. You need a stock purchase agreement. You need a vesting restriction. So incorporate soon to take care of those 3 things. Now I know what you're saying. Gee, what if I can't afford a corporation? Again, I have 3 things to say about that. Number one, incorporating is dirt cheap these days. My firm is actually my old firm, the Royce Law Firm. We built an online incorporation tool. It cost almost nothing, and it crashed so many times because I couldn't respond to the demand. I'm rebuilding that tool at Haynes Boone. It's going to be called HB Start. It's an online dirt cheap incorporation tool, and even if you don't use mine, they're out there. A person can incorporate really quickly and easily. But that's not enough. That's not good enough. You also have to put in place your technology agreements. You got to put in place sometimes offer letters or employment agreements, but definitely your equity agreements. To do that, you really should have a lawyer. You really should have a lawyer. And that brings me to the second thing. Incorporation is cheap. Point number 2 is you got to get your feet wet, right? You got to get your feet wet to do this. You are going to have to spend a little bit of your own money. And this stuff does not cost that much. And you can oftentimes find lawyers who will defer fees, but you've got to have a little bit of your own skin in the game. And from my standpoint, as an angel, if I see a company that isn't willing to advance a little bit of money to even incorporate, if I see a founder that's not willing to do that, that's a founder that's not very committed to his company. It doesn't make me feel very good. I don't get a warm, fuzzy feeling out of that. Okay, was that 2 or was that 3? That was 3. IP, stock ownership, and vesting. Okay, all right, we've got a few more questions here. Let's see if I can understand this. All right, so someone's going to incorporate online and not sell any stock, and then put all this stuff in place later. Okay, that works fine if you're if it's a one-person corporation. It doesn't work so fine if you've got a co-founder. It doesn't work as well if you've got other service providers, because you need something in writing, and it doesn't take very much, but you need some magic language that says, look, this is what I own in your company, if anything, right? By the way, why is that so important, right? How many times have I seen companies come in and they finally got the investor lined up, and now they want to paper the deal. And all of a sudden the founders, they have a misunderstanding or a disagreement as to what percentages they own. And they say to me, well, gee, we can't agree on what percentage we own. What do we do now? And I say, well, you go home and you start over. You go with a completely different company. If you can't agree, you're screwed. You're toast. You're dead on arrival. That's a big mistake. You have to be able to because investors are not going to finance a lawsuit, and they're not going to finance your equity squabble. So if you have co-founders, you want that in writing. Now, it's more important to have something than nothing. If you have nothing, it's my word against yours. If you have something in writing, it's pretty hard for somebody to challenge that, say, no, that's wrong, even though I signed it. And then secondly, the IP, you want people to assign their intellectual property rights to that company. So you, the company, can represent to your investors that you own the IP. You can only do that if you've got your IP assignments. So yeah, so I think it's unfortunate there are so many do-it-yourself sites up there that give you no legal advice and they don't tell you all the ways you can die by doing this stuff. So I'm totally in favor of automation. Us millennials are like that. We like automation and to reduce cost. On the other hand, I'm totally against people screwing up their companies. All right, folks. We are now at 8:30. I'm losing my voice here because I've talked so much for the last hour and a half. I've answered most or all of your questions. If I haven't, feel free to email me. I'm Roger Royce, Haynes and Boone in Palo Alto, California. And at this point, I am going to turn it back over to our host, Rob Lau at Idea to IPO.
That was a lot of good information and actually kind of entertaining. Roger, thank you for your expertise and your sense of humor. Audience members, thanks for tuning in, asking great questions. See you next time.